If you make money from something you enjoy, baking, photography, reselling, crafts, the IRS puts you in one of two boxes, business or hobby. Get the business box and you can deduct expenses and even losses. Get the hobby box and here's the brutal part. You still pay tax on the income, but you can't deduct a single expense against it. Same activity, wildly different tax bill. Let's break it down. Start with the part almost nobody knows. Hobby income is fully taxable. Sell $3,000 of your photography as a hobby, and that $3,000 goes on your return as income. There's no minimum, no hobby exemption. The "my hobby isn't taxed" idea is a myth. The IRS taxes the money either way. So where does hobby income go? Right here, this is Schedule 1 straight from the IRS line 8J, activity not engaged in for profit income. That's the hobby line. It flows into your taxable income like wages do. And notice what's missing. There's no expense line next to it. That absence is the whole story. Because here's the trap that makes the hobby box so expensive. Since 2018, hobby expenses are simply not deductible, and the 2025 tax law made that permanent. Spend $2,000 on supplies to earn $3,000 of hobby income, and you're taxed on the full $3,000. Not the $1,000 you actually cleared, the full $3,000. Now flip to the business box. A business reports on Schedule C, deducts every ordinary and necessary expense, and pays tax only on the net profit. And if the business loses money, which is normal in the early years, that loss can generally offset your other income, like your W-2 wages. The business box is better in almost every way, which is exactly why the IRS guards the door. So what decides which box you're in? One word: profit motive. A business is run to make money. A hobby is done mainly for enjoyment with income as a side effect. You don't get to just declare yourself a business. The IRS looks at how you actually behave, and they've published exactly what they look for. The IRS weighs 9 factors. The big ones. Do you run it in a business-like way with real records and a separate bank account? Do you put in meaningful time and effort to make it profitable? Do you have expertise or advisors who do? Have you made a profit in similar activities before? And do you depend on the income, or is this funded by your day job for fun? The rest, your history of income or losses in this activity, whether you've had at least occasional profits, whether you expect the assets like equipment or a brand to grow in value, and how much personal pleasure is involved. No single factor decides it. A pattern of losses plus a fun activity plus sloppy records is how you lose. Profits, records, and adjustments are how you win. And there's a shortcut worth knowing: the safe harbor. If your activity turned a profit in at least 3 of the last 5 years, the IRS presumes it's a business, and the burden shifts to them to prove otherwise. Fail that test and you're not automatically a hobby. You just have to win on the 9 factors instead. Let's run the same numbers through both boxes. A photographer earns $6,000 and spends $4,000 on gear and travel. As a business, taxed on $2,000 of net profit. As a hobby, taxed on the full $6,000 with the $4,000 of expenses just gone. In a 22% bracket, that's roughly $900 more tax for the exact same year of shooting. Example 2, the one the IRS actually hunts. Someone with a healthy W-2 salary starts a weekend horseboarding operation that loses $20,000 a year every year and uses those losses to wipe out tax on their salary. No price increases, no cost cutting, no business plan, just losses and fun. That pattern screams hobby, and when it's reclassified, the losses are disallowed, with back taxes and penalties on top. Notice what actually separated those two: behavior. The photographer who raises prices after a bad year, drops the unprofitable wedding line, and keeps a ledger looks like a business even in a loss year. The one who shrugs and keeps doing it for fun looks like a hobby even in a profit year. The IRS reads your actions, not your intentions. So if you want the business box, act like one. Open a separate bank account and run everything through it. Keep books, even a simple spreadsheet updated monthly. Write a one-page plan showing how this becomes profitable. Get any licenses your field requires. Track your time. And when something loses money, change it and keep the record showing you did. One warning for the other direction. Don't fake a business just to harvest losses. Deducting years of losses from an activity you never seriously tried to make profitable is exactly what Section 183 exists to stop, and it's a well-worn audit path. The business box is for real attempts at profit, not for making your fun deductible. Quick recap. Hobby income is taxable, but hobby expenses are not deductible, so the hobby box means paying tax on money you didn't actually keep. Business status comes from profit motive, shown through the 9 factors, with a 3 of 5 years profit safe harbor. Run it like a business, document everything, and you get the box that saves you thousands. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. It's always educational, never advice for your specific situation. Bottom line, the money is taxed either way, the only question is whether your expenses count. Treat your side activity like a real business. Keep the paper trail, adjust when you lose money, and the tax code treats you like one. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.